No major changes in the statement, Mark. We do see no clear changes in the forward guidance with regard to when the Fed will start raising interest rates in this latest statement. However, we do see in the forecast still the Fed calling for, or likely calling for, 2 rate increases this year. They are acknowledging recent improvements in the U.S. economy, but they're also downgrading their GDP forecast for the year. Let me walk you through the statement here. The most significant changes deal with the most recent assessment of the U.S. economy. I'll read directly from the statement. Economic activity has been expanding moderately after having changed little during the first quarter. The pace of job gains picked up while the unemployment rate remains steady. On balance, a range of labor market indicators suggest that underutilization of labor resources diminished somewhat. Growth in household spending has been moderate, and the housing sector has shown some improvement. However, business, fixed investment, and net exports stayed soft. Now we'll get into the inflation discussion again. No changes, major changes here. Inflation continued to run below the committee's longer-run objective, partly reflecting earlier declines in energy prices and decreasing prices of non-energy imports. Energy prices appear to have stabilized. That's one new piece of language in there. Market-based measures of inflation compensation remain low. Survey-based measures of longer-term inflation expectations have remained stable. Again, with regard to the forward guidance, still the same, what we've been seeing for some time now. The committee anticipates that it will be appropriate to raise the target range for the federal funds rate when it has seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. The vote here was unanimous in support of this statement. Let me walk you through quickly, if I could, the summary of economic projections. This is, of course, the Fed, the policymakers updating their assessment of the economy going forward, as well as their projection for interest rates. With regard to the Fed funds rate, 15 of 17 Fed policymakers still believe the first rate increase will happen this year, 2015. 2 think it'll happen in 2016. That's not a change from the last time we saw this assessment. The end of 2015, the median for where the Fed funds rate, based on those 17 policymakers surveyed, will be 0.625%. That is the same as what we saw back in March, so no change there. It again suggests that there are going to be 2 rate hikes within this calendar year, 2015. We've got 4 meetings to go after this. 2016, the end of 2016, the median forecast is for the Fed funds rate to be at 1.625%. That's lower than what we saw in March, so that suggests, again, implies fewer rate hikes in the calendar year 2016. The longer-run target for the federal funds rate, 3.75%. That is not a change from what we saw previously. In terms of the economic numbers, the big one standing out here is their downgrade for GDP for 2015. Given what we saw in the first quarter, that contraction in the first quarter, they now see the central tendency for GDP growth 2015, 1.8 to 2% growth. The prior number was 2.3 to 2.7%, so a pretty significant downgrade. Again, that mainly reflects the first quarter. Inflation basically unchanged in their forecast, and their preferred gauge for inflation, 1.3 to 1.4% for 2015. Unemployment, they do see unemployment now between 5.2 to 5.3% by the end of this year. Again, that's somewhat of a walk back from where they saw it previously. Full employment over the longer run, they still see full employment 5% to 5.2%. So bottom line, Mark, they are seeing some improvement in the short term in the economy, but they see the full year not being what they originally anticipated, but they also, based on their forecast for the interest rates, still see 2 rate increases this calendar year. They're going to have to get up and start moving if they want to achieve that. 4 meetings to go.